All right. Good evening, everyone. You're welcome to today's session. So, as indicated in the group, this session is all about discussing financial modeling. So, what we'll be basically talking about today is how do you model a financial data? The technique and strategy we'll be applying in this session can be used across different projects and across different tasks. If you are trying to model revenue, if you are trying to model cost, you know that the emphasis in today's world is to maximize revenue, otherwise called to maximize profit, and to minimize cost. So there's a way you can model your revenue and then improve it to be higher than it was. And there's a way you can model your revenue, model your cost, and decrease it lower than it was. So the first question we want to answer is, what is financial modeling? In fact, let's pick the word modeling. What does it mean? We all know what financial means, anything that has to do with money. Then what does modeling means? In a simple sentence, modeling simply means identifying pattern and predicting outcome. Simple. When you go to Google and you search modeling, it will give you big grammar, long English. When you read through and you digest, you understand what Google is talking about. If you go to ChatGPT, the same thing applies. But in my own explanation, what I can say about modeling is basically identifying pattern and predicting outcome. Take for instance, if you are a businessman and you sell, let me say, glass cup, you sell glass cup. So modeling in this situation is to identify pattern in the revenue for the sales of glass cup and then predict what future sales will look like. If you are selling books, the same analysis applies to it. You need to understand, what is my sales this month? What was my sales last month? What is the sales last 2 months? The same thing applies for a period of 1 year. Now, after you've understand how this sales is, that is what identification of pattern is in this situation. That's observing what has happened. Now, after you've observed that in January the sales is around 2 million, in February the sales is around 4 million, in March the sales is around 10 million, in April the sales is around 2 million, and so you can easily identify pattern in your revenue, and with this you can then predict in 2026 January, considering what has happened from January 1st to the last day of December 2025, then in 2026, what will be my revenue? What would it look like? That's predicting into the future. You can do the same thing for February, you do the same thing for March, you could do the same thing for April, all the way to December 2026. And if you want, you can actually extend the model to 2027 and 2028. And this is how it works. For you to create a model, you need to understand the process. For you to create a model, you need to understand the process. If you are creating model on production, you need to understand the process of production. If you are creating a model on sales, you need to understand the process of sales. And the process of sale is simple as, if I sell 1 unit, I make 2,000 naira. If I sell 2 units, I make 4,000. If I sell 3 units, I make 6,000. That is the process of sales. And if you are a marketer, or if you're in the marketing department, then you need to understand what is the technique involved in marketing. That is exactly what will help you shape your assumption before you now come up with your model. This is just an explanation of what modeling is, and I'll link it to financial modeling before I share my screen and then show you how to go about the whole process. So, like I said earlier, modeling is all about identifying pattern and predicting into the future. Modeling can be applicable to anything, either revenue model, cost model, expenses, equipment, assets, anything you can think of, production, marketing, sales, anything you can actually create a model around it. But our emphasis today is a financial model, and I will show you some of the templates I have in regards to financial model so you can actually make reference to it and see the whole point of view. Then you can use that to do something necessary in case if the need arise. So that is the definition of model in a simple way that I think I can explain to you. So before I move further to the next part, I would like to ask if there is a question so I can answer them before we make progress. So do you have any question in regards to the explanation I make? If yes, you are free to unmute your mic and ask your question. And if no, just 2 seconds, just say there's no question so I can make progress.
There's no question on my part.
Okay. Then if I
You
may
have a
ask,
question?
all right, if I ask, is I don't know, is the video in real time? Do you hear me in real time? It seems as if there's a
Yes,
lag.
yes, yes.
Yes,
I can hear in real time. I'm in Ghana.
clear.
All right. All right, go ahead. Prince, your question.
I want to ask, if you say financial modeling, does it mean that financial modeling is going to look at a combination of cost and then revenue?
Yes. Financial modeling is a combination of cost and revenue. And
Okay,
when you say financial modeling, the first thing that comes to the mind of people is modeling an income statement.
okay,
That's what comes to mind. And you know that income statement captures revenue, cost, that's operational cost, cost of manufacturing. You have your taxes, you have your depreciation, amortization before you get your net income. So
right.
when you say, when you say financial modeling, that's the first thing that comes to the mind of people. However, if you are trying to model operation, then you can give it operational model. If you are trying to model production, you call it production model. And if you are trying to model only revenue, then you call it revenue model. Mr. Mubi, we can't hear you. It seems as if you are speaking.
No, everything is okay. Everything is okay. I don't have any problem with your explanations.
Okay,
I'm in
okay,
order.
okay.
I'm in order. Yeah, we're good to go.
All right, let me share my screen with you all, and then I'll open this document so you can see how it looks like. So this document is a typical representation of a financial model. Typical representation of a financial model. Now, before I explain what you can see here on the document, let me briefly say something. Modeling for finance can be done in three conditions. Number one, when a company is starting afresh. Let's say you register the company, you've done all the accounting related stuffs, then you want to begin production. You can create a model with that. That's at the beginning. So you have a blueprint of what you want to achieve. So in situations like this, your assumption will be based on information that you get from other sectors. Let's take, for example, if you create a company that produces a smartphone. So at the initial stage, you don't have historical data. So what you are using is information of a competitor. You have to make research. What has this competitor done? What is their revenue like? What is their quantity like? After you've made that research, then you can now use it as your starting point for your own model. That's if the company is a fresh one. That's the first situation. Then the second, if the company is already existing. Now, when the company is existing, it simply means you must have done businesses in the past. You must have some financials. You must have had some financial metrics in the past. You must have had some values that reflect your revenue, some values that reflect taxes, some values that reflect cost, and the likes. That means there is a financial data the company currently has. When you have this, then you can now use this financial data, understand the pattern this financial data has. Then you use it to predict future outcomes. That's the second situation. Then there are two. These are the two situations where you get to use financial models. So creating financial model using existing data is quite simple because you are working with what the data says. That means before you model for 2016, you must have observed what 2015 reflects. You can't just say, for instance, if in January 2015 revenue was $2,000, for instance, in February 3,000. Let me just say the revenue was fluctuating between 2,000 and 3,000 from January to December 2025. Now remember that in 2026 January, if you are estimating, you first of all calculate the percentage of growth in this revenue over time. You can't just be estimating $5,000 sales when from the previous day you are dealing with around $2,000 or $3,000. So you can't just jump to $5,000. No, you'll be estimating maybe slightly 3,000, or you'll be estimating above $3,000, which is more realistic. That's that. But if you are starting afresh, that's the most difficult part because it's not easy to make research and understand what your competitor is doing because a lot of information will be hidden. So that's why creating model for a fresh company na headache. You will crack your brain very well. At some point, you will get confused and you don't really know what to do. So that's just what it is. So what I'll be showing you now is a model that will be created for a fresh company. So you see how it looks. And after that, I will show you a different template for a model of an existing company. So you also see how it looks. And then you will be the one to make your own research. If you really want to work on any model, you have to make your own search. You go to YouTube, you can search for materials, you use ChatGPT. ChatGPT will explain a lot of things to you, and from there you get to understand more. So my duty here is to introduce you to the basics and help you get started. So let's hit the nail on the head. This document is a financial model for a startup, a company that is non-existing. So we are starting from scratch. So as a result, we need to make some assumptions in order to get started. So if you observe carefully, you realize that what we have here is a typical summary of an income statement where you have your revenue, your cost of goods sold, then you use it to calculate your gross profit, then you display your operating expenses, then you deduct any tax, which is this section, and then you get your profit or you indicate your loss. This is just a typical representation of a summarized income statement. So what I'll be doing now is to create some assumptions at this point. Then I will now use these assumptions to actually model how the income statement will look like. So that is what we'll be doing now. So we have a company, we created this assumption depicting a company that produces a product, whatever it is, and then it sells this product. So at the starting point for year one, you could see that this analysis is from 2023 all the way to 2027. So at the top side here, it reflects year one. You could see that we've actually presented some basic assumption to start with. Then every information for year two will be displayed here. Information for year three will appear here. Information for year four and the likes information for year five will appear here. So in trying to make some assumptions, this is where I now explain that you need to understand the business itself. For you to create this model, you need to understand how the business work. So, and since we are creating this for an income statement, then financial modeling is a task of the financial accountant, but the financial accountant need to have the knowledge of financial analysis. You know, there's a difference between financial accounting and financial analysis. So the financial accountant needs to have deep knowledge of financial analysis in order to understand how this model are created. So for a basic starting point, we assume that the company will produce 3,000 units of the product. So we say number of orders. You can actually change this to units produced. It doesn't matter. Number of orders is the same as units produced. So assume that the company started production by producing 3,000 units. Then the next row captures the growth rate. If we say units produced here, then this other growth rate is in relation to the units that were produced. Let me just take this back to what it was. So we have number of orders, and this is the order growth rate. That is, at what rate will this order grow as time goes on? We'll fill that information. Now, the average order value is the same as price, which means how much can this product be charged? The price will appear here. Then we have information related to manufacturing and cost. Then for the cost of producing the product, that is the direct cost of producing the product. This has to do with labor and capital. How much is the per unit cost of the labor, that is those that work in the factory? How much is the per unit cost of capital? This is what we now summarize as manufacturing. Now, after the goods has been produced, how much does it cost for the company to fulfill an order? Maybe the company is producing books. Then for each book that is produced, how much will it cost to sell it? That is the value we capture here, which is in dollar. Then aside this, we now have other operating expenses that captures warehousing. How much do you want to spend on warehousing? How much do you want to spend on salaries and payroll? How much do you want to spend on marketing? And then any other information that is available. So while explaining this, remember that in your situation, you can actually expand this beyond the scope of what you see. If you are interested, you can expand it so it can capture a lot of information. But the information I have is exactly what is available here. Then finally, this is for corporate tax, which reflects to the tax rate that one will definitely, that the company will pay, which is something we have here. So now, the next thing for us to do after understanding each line item that reflects the assumption is for us to now start making prediction into the future. So we said in 20, what? Okay, we said in 20, let me freeze this top side. so that I can actually scroll and then get to see them. View and then free spin, freeze. All right, so that even if I scroll down, I can actually see the year I'll be dealing with. Now, this is 2023. If in 2023 we make this, then what growth rate are we expecting in 2024? Now, you need to actually understand the capacity of the company and see at what level can the company increase production. If it is by 100%, you type 100%. If it is by 80%, you type 80%. Now, 100% means if you produce 3,000 units here, then you produce 6,000 units in 2024. That means production has increased by 100%. However, based on the understanding of the production process you have, you can actually model this to any amount. So let's leave this to 80%. Now, in 2023, we are expecting that the company will be more efficient. It must have learned from its mistakes. It must have adjusted, and then it must have been more efficient than before. So that means the company might produce, let's say, on a scale of, let me say, 90%. That might have increased. In 2026, we could just say the scale has increased to, let me say, 95%. And then in 2027, let's say the capacity increases to 100%. Now, these values are assumptions. You just impute them in order to understand how it will respond. Now, it is based on these assumptions that we will now calculate the growth of product that we produced. So in this situation here, I will now begin to impute Excel formulas that will now do the calculation for me. And let me zoom in so you can clearly see how the formulas will be imputed. If you have a question or if you don't understand something, you can just say something so I will know that, or maybe if at the end of the session you actually go through the record, you understand more. So I will zoom in now so that when I'm entering the formula, it will be very bold for you to see. Now, this is it. I will introduce the equal sign and then I will click this cell so that it will indicate this is D30. Then I will now multiply it by, I will open parentheses, then I will say 1 plus the percentage of growth rate, which is 80%. Then I will close my parentheses. So this is the formula I imputed. You type the equal sign, you introduce D30. D30 is these cells that capture 3,000. Then you put asterisk, which is a symbol for multiplication, open parentheses, then you say 1 plus, then you now make reference to this cell, which is E31. That is the percentage growth. This is how the formula is. So if I hit enter on my keyboard, you could see that from this to this, the order value has increased by 80%. So that simply means if in 2023 we have 3,000, in 2024 we are expecting a total number of 5,400 units to be produced. So that's how you do this. Now, when you go to year 3, you repeat the same thing, introduce the equal sign, make reference to the previous year, and then introduce asterisk, which is a sign of multiplication, open parentheses, 1 plus, you make reference to this cell, you close your parentheses, and then you hit enter. So from 2024 to 2025, we experience a growth of 90%. In 2026, we'll repeat the same process. Type the equal sign, make reference to this, introduce asterisk, open parentheses, 1 plus, you click on this, which is the percentage of growth rate, close your parentheses, and then you hit enter. And you have something that looks like this. So on the final year, I can just drag this cell, and this is exactly what I have. Now, ideally, at the beginning, this is what I have: 5,400, 10,000, 20, and then 40,000. So let's take, for example, I can actually clear these 3 cells, and after calculating this one, I will just drag all this way and it will calculate the rest for me. That is the power of Excel. So I actually take it one step at the other so that you understand, but also understand that there is a way it can be done faster. So we've actually assumed some values for the number of goods that will be produced. Now we can do the same thing for the average order value. So if assume that the price for this product is, let's say, is $40 in 2020, in 2023, in 2024, how much do we think the price will be? If it will be $30, or let's say, no, if it will be $41, then we specify. In 2023, let's say it will be $43, and then the next year will be $44, then finally the last year will be $45, because we know for sure that the value of a product will never remain the same across 5 years. It will definitely change. If, let's assume, this model is on a yearly basis, it's captured parameters from January to December, then we can use a single value for 1 year. But from 1 year all the way to 5 years, there is no way, it's not possible for the price to remain the same. So that's why I said in the beginning, understanding of the process, understanding of the business will help you make realistic assumptions. So this is for order value. We are done with that. Then the next thing is for manufacturing, and then the cost of sales. So for manufacturing, in this instance, let's assume that as time goes on, the company gets more efficient and then minimize the cost of production by avoiding waste. So we could say that in 2023 we have this. In 2024 we could say we are dealing with 6.35. In 2025, let's say it becomes 6.20. Then the next year become, let's say, 6.15, and then finally we have 6.00. So let's assume that due to efficiency, the company was able to reduce its manufacturing cost from this amount all the way down to this. Then the cost of order, maybe the amount you pay for each unit that someone place an order is 2.25, or let's round it up to $3 in 2023, and let's assume that the price remained the same all the way to 2025. But in 2026, for whatever reason, we could say that the amount increases to $4, and then in 2027 it increases to, let's say, $4.5, and this is exactly what we have. So we've now create an assumption for this. Then this is a section for operating expenses. At the initial stage, you specify the value, and then you assume how changes will affect it over time. So if this is 20,000, you assume the value across all the way to 2025. Now, to make this easier and for us to be faster, I will just drag this to this point so they can be the same. And then anything from year 4 and 5, I can actually change the value. So I will say this has increased to 25,000. Then this increases to, let's say, 55,000. Then this increases to 30,000. Then this increases to, let's say, $7,000. And then I can now drag this to the next year. So this is what I have. I have now created an assumption for my operating expenses. Then the next thing is my tax rate. Let's assume, due to the fact that this is a new company, the government will give you decrease in tax for 5 years. Let's say the government was able to give you 10% tax, or let's say maybe 20%. Let's leave it the way it was, 20% tax, and then it's run through the 5 years. That means the tax will remain the same all through 5 years. So all the information we've entered so far are assumptions, and now we've completed all our assumptions. So this is how they now look like. Now, in your situation, if you have any other thing to add in between, you can add some cells by inserting them, or if you have other expenses, you add them by inserting. But make sure it reflects in your income statement as well, so that all the calculations will be in order. So this is how you get to make some assumptions in regards to income statement that is in regards to financial modeling. This is how assumptions are made based on understanding of what is currently happening in the business. That's why I said earlier that you need to identify pattern. So identifying pattern is understanding how the business operates. Then before you can now predict by assuming that what if this happened, or what if this happens, and the likes. So this is what I have here now. All right, so let's go back and then make some calculations that reflect this. Now, for those who are enrolled in the financial statement analysis course, you might have seen how we use Excel formulas to calculate revenue, cost, while linking it to the general journal. How bulky the formula looks like, that was linked to the general journal, even though it was simple, but technically it looks complex. So for those that have that course, will understand more of how linkage is created between some sheet in Excel in relation to how they appear on the income statement. Anyway, let's make progress. So to calculate revenue, we all know that revenue is basically the amount you sell and the units you produce. So if you produce 10 units and you sell it for 10 naira, your revenue is 10 times 10. If you produce 50 units and you sell it for 5 naira, the revenue is 10 times 50. So in this situation, it's very simple. Introduce the equal sign, and then you scroll down. You then click on the amount that was produced, which is this. If you look at the formula bar here, it says D30. So once I click here, I will move to the formula bar, and then I will click on it in order for the formula bar to become active. So I will say D30, I will introduce asterisk, which is the multiplication sign. So it becomes D30 times the average order, that is the price. So this times this, D30 multiplied by D32. This is how it's done. When you hit enter on your keyboard, it will calculate the value for you at the top side here. Then when you come back to the next year, you repeat the same thing by typing the equal sign, and then you come back, you click on the value that was produced for 2024, and then you go to the formula bar, type in the asterisk, which is a sign of multiplication, and then you click on the price, then you hit enter. So you could see that we've calculated for year 2. So like I said, there is always the easier way to get things done. So since I have calculated for this and this, if I just drag the formula, it will do the remaining calculation for me. That's how smart Excel can be. Now, for instance, to be sure that Excel actually did the right calculation, you double click on this cell. You look at the referencing. The referencing, if I scroll down, is this multiplied by this, which is correct. Because if we were to do it manually, we'll definitely type the equal sign. Let's zoom in. Let me zoom in. If we were to do this manually, that means I will type the equal sign, then I will type this one by selecting it, then I will introduce the asterisk symbol, which is what you see here. Then I will now click on the next cell, which is this, and it will give me the same value. That means Excel did the right thing and we are correct. So we've calculated revenue. Now we'll repeat the same thing to calculate manufacturing and also do the same thing for other fulfillments. Now, since I was detailed in calculating that of revenue for manufacturing and other, I'll be fast about it in order to save time. So I'll type the equal sign here. I will click the units, and then I'll now introduce asterisk, which is this. Then I'll multiply it by this, and then I'll hit enter. So this is what I have. I'll drag to the edge. Then I'll repeat the same thing for this one by clicking on this, introduce asterisk, and then I will now make reference to the other fulfillment. Sorry, there's a mistake. So I'll introduce asterisk, which is a sign of multiplication. And then I will now make reference to this cell. Then I will hit enter. So you can see that I've calculated for this as well. Then I can drag to this place. So what I did here is exactly what we did here. Simple and straightforward. Now, after we've gotten that, then we need to calculate our total COGS, otherwise called cost of goods sold. So I can use the sum function in Excel. If I type in sum, I will activate the open parentheses, then I will drag this range, close my parentheses, and then hit enter. I'll repeat the same thing here by typing the equal sign, and I will type SUM. SUM is the formula for addition. So once I type SUM, I will now hit tab on my keyboard. It will now activate the sum function. You get? So I can now click here and drag those two cells. Once I drag, it has captured the range E7 to E8, just two range, nothing more. Then I'll close parentheses manually, and then I hit enter. It has done the same thing for this. So to be faster, I will just move my mouse cursor to the edge just like I did earlier. I will drag all through, and this is what I have. So we are done with the cost of goods sold. Now, if you scroll down a bit, this is where you now calculate your gross profit. And we all know that gross profit is nothing but the revenue minus the total COGS, cost of goods sold. And this is the value you have. So for 2024, you type the equal sign, you click on revenue for 2024, which is this. Then you type minus. You know, if you look at your keyboard, there is the minus sign that's closer to the equal sign. You type minus, then you select this cell, and then you hit enter. You've now captured your gross profit for 2024. So you repeat the same thing, revenue minus cost of goods sold, equal sign, revenue minus cost of goods sold, then finally equal sign, revenue minus cost of goods sold. And this is what you have from this point all the way here. So you've calculated your gross profit. Now, the next thing is to look at the gross profit margin. And the gross profit margin is a very strong metric in explaining how finances connect to each other. If your gross profit margin, based on my knowledge, based on what I have seen and the knowledge I have had so far, if your gross profit margin is not greater than 50%, then your business is shaky. If your gross profit margin is not greater than 50%, then the business is shaking. With time, as long as it is less than 50%, that means with time, the company might actually be approaching liquidation, or, you know, in a bad state also like that. So gross profit margin is encouraged to be on a higher level, because that is the first indication that the company is actually on the right track. So to calculate the gross profit margin, now that's the difference between, that's one difference between accounting and financial analysis. As an accountant, you understand what gross profit margin is, but what impact does it has? That is what the financial analyst will explain. And you get to see issues like what I just said, that if the gross profit margin is no more than blah, 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 it should be like that. So that's an example of that. So accountants do the calculation, keep the record. Financial analysts understand the impact of some key metrics in the finances, translate what it means to the business, what it means to outside world, what it means to competition, and then how can these metrics be improved. This is financial analyst coming in. So if you so to get gross profit margin, this is what you do. You type the equal sign and then you say your gross profit, you divide it by your revenue and then you hit enter. So you've gotten your gross profit margin, which is 76% in this situation. To get the one for 2024, you type the equal sign, gross profit divide by revenue, and then to make it faster, I will just drag, and this is what I have. So you could see that as a financial analyst, it's already telling you that 2025, oh, I forgot that this is a model. But if assume this is not model, this is a historical data that happens in real time. This is the actual data. So you can see clearly that the company is doing more better in 2025 than other years. So your interpretation in after analyzing the finances is to say that 2025 is a more better year. So the question now is, what happened in 2025 that made the value 79%, which is closer to 80? And how can we replicate these values across years in the future so we can have the same level of growth or much higher growth? That is some analysis that a financial analyst can actually bring up. So this is just what we have based on the model we've calculated, and then we can now move to operating expenses. So under the operating expenses section, we have different bills to pay. We have bills in related to warehouse, bills in related to salaries, bills in related to marketing, and bills and other bills. So in this situation, we've already assumed some values for them. This is not in percentage, we just assumed an amount for them. So the only thing we'll be doing here now is to use dynamic cell referencing. Dynamic cell referencing. Let me zoom out. Dynamic cell referencing. That's what we'll be using. So, and this is how it works. If you are linking cells dynamically, the only thing you need to do is to type the equal sign, then you select the cell you want to link to. After that, you hit enter, such that this cell now is already linked to this cell. This is 20,000 and this is 20,000. So if I change this to 50,000, if I change this to 50,000, this will also change to 50,000 because they've been linked together dynamically. So let's take it back to 20,000. Now, to link the next cell dynamically, you type the equal sign and then you select the cell and then you hit enter. Let me zoom out again, or let me just go to full screen so you can see them at the same time. So to link this cell to this cell, I will type the equal sign and then I will click, then hit enter. That's all. Go to the next one, type the equal sign, click, hit enter. That's all. Go to the next one. So you just click on the cell, type the equal sign, and select the one you want to reference. Then you hit enter. And what you have here will be equal to what you have here. It's as simple as that. So since I have done that of warehouse, which is exactly what we have here, for that of salaries and marketing, what I will do now is to select all through, and then I will just drag them down. So it has reflected. And you can see that I have 7,000 here, 7,000. Above it is 30,000, and above is 30,000. If you cross-check it, you realize that they are correct. And if I double-click, you can see that the equal sign E40 is the same thing. So that means Excel has helped us with the manual work by just dragging. So to get our total expenses, let me zoom in. To get our total expenses, I will type the equal sign, type SUM. You can see that Excel has given me some recommendation. You know, Excel is very smart. If I type SUM, it will now begin to ask itself, what am I trying to do? So it has given me some list of formulas that begins from SUM. One of them is this SUM, the other is sum if, some ifs, some product, they are much. So if what I want appear as the first line, when I just hit tab key on my keyboard, it will just make this formula active. So this is one cheat I just explained. And if, for example, what I want is sum if, after typing SUM, then I will use the arrow key on my keyboard and then I will go down once. You can see that sum ifs is the one highlighted in blue. Then I hit tab, sum ifs becomes active. And I can do the same thing for any other one. So if I type SUM, I can just go down by pressing it. And if this is what I want, then I will hit enter. I will hit tab on my keyboard and it has changed to IMSUM. But our interest is SUM, and this is this. That's the summation function. Then I will select this range from the top side here all the way to this point. Then I will close my parentheses and then hit enter. So this is what I have for 2023. This is what I have. Then in 2024, I will repeat the same thing. SUM, hit the tab key on my keyboard, then drag all the way here, close parentheses, and then hit enter. For 2025, I will repeat the same thing. Then I will drag, close parentheses. Then for 2020, I can just, to make it faster. And this is what I have. Now, to get my operating profit, we all know that your gross profit minus the total of operating expenses will give you your operating profit. Now, there is a meaning to operating profit. And from the financial analysis point of view, the meaning of operating profit is basically an indication that the company is actually on the verge of making profit. That is profit from business operations. Operating profit is different from net income. Operating profit is an indication of profit within business operation, that is from production plant. It's just like saying you have $100,000, you went to market, you purchase goods, after you pay for transport, after you pay for house rent, after you pay for electricity bill, after you pay for bills that you have to pay for before the company can survive. After you've encountered all those expenses, the amount you get is your profit from operation, which is an indication that the business can stand for itself. That's what it means. It means the business can stand for itself when your operating profit is positive. But if your operating profit is negative, then the business cannot stand for itself. Then it is now a question of what brought about this negativity. Is it from the operating expenses or is it from production? That's where you now go back to the manufacturing cost to look at what is going on there. Yet, but if I once analyzed the finances of Dangote Sugar, for those who enroll in the financial statement analysis course, when you go towards the end of the course, there is a section for analyzing the financial statement of Dangote Sugar. The financial statement of Dangote Sugar is very funny. How can a company be making a large revenue and the gross profit is below 50%? The gross profit is counting around, is it 28%? Gross profit, not operating, gross is counting around 28% when the company is making huge revenue closer to 1 million. Is it 1 billion or 1 trillion? I forgot. So from the analysis, what is actually consuming this cost is the manufacturing cost. That means Dangote Sugar, one way or the other, I don't know what's going on, but one way or the other, from what is happening inside the production plant. There's things that has to do with cost of raw material, cost of labor, cost of capital. From what is happening within production plant, the company is spending a lot of money, and the financial statement clearly show that. If you can go to finchart.io, you get to see the financial statement of Dangote Sugar. You understand more of what I'm saying. Or for those who enroll in the financial statement analysis course, who clearly understand. If you go to the section for this, you understand what I'm trying to say. So the point here is operating profit is an indication that the company can stand for itself, meaning the company has generated funds that it can use to pay its bills, and then still stand strong. So, but the magnitude of how strong the company stand is determined by the level of the operating profit. So, for instance, to calculate operating profit, you introduce the equal sign, you say your gross profit minus your operating expenses. This is what we have here. Then the next one, we said gross profit minus operating expenses. Then the next year, we say gross profit minus operating expenses. You get, so that we can then drag this, and then this is the value we get. So from the analysis point of view, you can see that at this point, we have a loss of 8,500. That means in 2023, the company cannot stand for itself, because the company will need to borrow 8,500 in order to meet some of the bills that are available here. However, in 2024, the company can stand for itself because it has settled most of its bills and it still has additional amount, which means the company can actually stand for itself. That's for 2024. Then in 2025, the same thing applies. The company is much better, stronger. So the point I'm trying to make here is that the operating profit tells you the company is making profits from its operations, as the name implies. And what it means, literally in simple English, is that can the company stand for itself? Standing for itself, meaning it can pay its bills. We all know that in Nigeria, for instance, as a man, if you have money that you can feed yourself, you can clothe yourself, then maybe feed another person, clothe another person, then you are fit to get married. But if you can feed yourself and clothe yourself, but you don't have enough to feed others, then you are not fit to get married based on Nigeria, culture and stuff. So the same thing applies. If the company can feed itself, meaning from the money the company makes as revenue, it can pay its bills, then the company can stand for itself. And that is the meaning, that is the technical meaning of operating profit. So you could see that here it cannot stand for itself, but here, and here it can stand for itself. And we can say that in 2025, 2027, the company can stand it for itself much better than in 2024. So this is the interpretation. Now, to get the operating profit margin, you repeat the same thing by calculating this, then you divide it by the gross profit margin, the gross profit, which is this, and then you have this value. Then you type the equal sign, you click on this value, which is the gross profit, then you type divide on your keyboard, then you now click on the gross profit, and then you hit enter. 41%, wow, that's massive. 92%, which means the company is much stronger. We can see that the values don't lie. This is it. So this is how you get to calculate the operating profit margin. Then for tax, we already know that we have a value for tax, which is 20%. So to calculate how much will be here, then we need to calculate 20% of this. So, and the way to do that is very simple. You type the equal sign, you make reference to this cell, introduce asterisk, then you click on 20%, which is this, and then you hit enter. So you could see that this is 20% of this. Now, if I drag the cell Or let's do this one too, the equal sign, click on the operating profit, multiply by 20%, hit enter, you have this value. Then if you drag the way down, this is what you have. So even though the percentage remains the same, but the value changes over time, and it's simply because the value of our operating profit also changes over time as well. So this is what we have. Then finally, we can now calculate our profit or loss. So to do that, introduce the equal sign, you click on this minus the tax, you hit enter, then you equal sign, you click on this minus tax, yes, you hit enter. Then if I drag through, this is what I have. And that is the end of our financial model. Now, let me zoom out. Or before I zoom out, let me explain something. You know, in situations like this, for instance, the government can say, since this is your first year, if you make loss, you don't need to pay tax. You get? If you made loss, you don't need to pay tax. You know, government comes with policies at different points in time. So if the government policy says, if you make loss, so no pay tax, so but if you make profit, so you go pay tax. In that situation, then you need to remodel the formula so it can reflect that. But on a neutral level, which is more realistic, that is what you have. The government doesn't care whether you make loss. All they want is what is our tax. But for a serious government, they might say, okay, if you make profit, give us something. If you don't make profit, no wahala. So in situations like that, this is what you do. Then you now introduce the if function. So this is what I will do now. Follow me along. I will come to the beginning of the formula after the equal sign. Then I will introduce the if function, so that it will now say the equal sign if what is inside this cell, that is this cell now, what is inside this cell is, let me even start afresh. It's more easier to understand. So in case, if that is the situation, you come here, you type the equal sign, you introduce the if function, which is this. Then you say, if what is inside this cell is less than 0. Anything less than 0 is negative. You understand? Anything less than 0 is what? Negative. So if what is inside this cell is less than 0, what happens? You hit comma on your keyboard. Value if true is that if what is inside this cell is 0, then what will happen? Tax should be 0, because nobody should pay tax if your operating profit is less than 0. However, if what you have here is more than 0, I will introduce comma. If it is more than 0, then you can now calculate the tax by saying this cell multiplied by our tax rate, which is this. So this is how the formula looks like. If you look at the formula bar here, there's no way I can zoom in the formula bar, but this is how it looks like. Or you can see it from this level. So that we say if the condition does not meet, then we can now calculate the tax rate for it. So I will close my parentheses and then I will hit enter. So you could see that the value here is 0. So that if I run the formula through, it remains the same, but the if function has been applied to it. You get, each one I click has the if function, but it didn't change. The reason is because the value here we have is more than 0. But in this situation, what you have here is exactly what you have here, because you did not pay tax. That's institution where government say blah 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 blah. So this is how a typical a simple financial model looks like. This is very simple and basics. There are financial models that are more complex than this, but this one is very simple and basic. And the reason why it's called a model is because you can actually come here and say, what if we started with 5,000 units of product? If I hit enter, it will reflect the changes across all the metrics. So if here is 5,000 and our growth rate is still 80%, this and that, it will reflect. Now, if we started with 2,000 units instead of 5,000, Notice this value here. When I hit enter, the value will readjust. So if I hit enter, they will adjust again. And you could see that we are making loss. But if we started with, let's say we started with 10,000 units, you could see that we are making profit. And the tax for this situation has been calculated as well. But if we started with 4,000, for instance, you could see. So you can begin to try different values, different assumptions to see what it looks like. And if you are more technical, then you can create scenario. That's what we call scenario analysis. So that's for financial modeling, and everything here is subject to change. You can actually change it. For instance, if the manufacturing order in this year was $16, it will change everything that happens here. Let's take it back. And if the pricing was, let's say, $90 instead of 40, this is what we have. And if it remains the same across, you can see how it changes. Then if, let's take it back to it was, and this is exactly what we have. So this is a typical view of a financial model. At the end of this class, at the end of this session, I will actually give you access to this model. Then if you check the 10,000 plus Excel template, there is a model there. This you get to see this one in the 10,000 plus Excel template. This is another looks of a financial model. This is where you make your assumptions in a separate Excel sheet. Then this is where you model your profit and loss. This is where you model your balance sheet. This is where you model your cash flow. This is where you model your loan repayment. Loan repayment. And then this is notes and assumptions, where you can just mix on one or two notes. So this is a more intermediate financial model. The one I showed you earlier is just for income statement alone, which is this. But I showed you how to make assumptions. So if you understand this very well, then when you want to use this template, it will be easier for you to understand, because you know that in the forecasted revenue, we have different source of revenue. And then we can now impute the number of units sold. The units sold here is the same as the number of orders that we have modeled. So if you go back here, you can now calculate the average price, which will now in turn give you the average revenue per product. If you click on this now, at the formula bar here, you can see the formula that is used to hard code them. So this is for cost of goods sold, and then this is for maintenance, this is for depreciation, this is for tax. You make account for inflation, and then at what rate will the product increase and the likes you get. So these are your funding sources, your equity, which will now help you calculate your income statement, your statement of financial model, your cash flow model, your loan repayment, and the likes. So this is another example of a financial model. Let me close this. You can get this model in the list of the 10,000 plus Excel model, which is this. It's located there. You just need to search 5-year financial model. It will pop up. Then this one that says financial model is more complex. It's a more complex model. You can see how it looks. So let me just briefly explain what is going on. At the top side here, we have the actual values. You see, we have 2007A, 2008A. It means 2007 actual, 2008 actual, 2009 actual, 2010 actual. So from here to here, they are actual values that was gotten from the business operation. Then from 2011, you can see E. All these E are estimates. So 2012 estimate, 2013, sorry, let me zoom in. 2012 estimate, 2013 estimate, 14 estimate, 15 estimate, and the likes. So these are the respective estimates. Now, meaning after you've used historical values, then you can now predict future outcomes. And the way this model is located is very technical. If you capture gross sales, total sales that was made, in fact, if you are using this model, you will not start from gross sales. Rather, you are starting from the different products that is available for the company. For example, under beverages, maybe it's a company that produces soft drinks, that sells soft drinks. Under beverage, we have the percentage growth, meaning if the total sales is this value, the percentage of beverage from this value is 90%. Then what is the growth rate across time? The growth rate we calculated here, all this one we calculated here, is the same growth rate that was depicted across this line here. So the growth rate that is recorded was this value based on historical data of the previous record of the company. Then the one we estimated is this value. Then the same thing applies for the next product. What is the percentage of it from the total sales? Then how much is the value? This is value. And then what is the growth rate? This is it here. The same analysis applies for all this, all the way to confectionaries. Then you can then do that to calculate net sales and the likes. So this is a more complex model than the one we did. The one we did was a very simple, but it is the basics of understanding how financial modeling works. After you've understand that, the next thing is just to let me say, understand how the template works, or understand the way you are to create your own model and how you are to link the formulas together and the likes. So this is it. Then this is for income statement. We have the one for balance sheet, which is here, the same structure, the cash flow statement, property, plant and equipment, the debt schedule, the discounted cash flow. Discounted cash flow is one of the very, very serious topic in financial analysis, very complex. I'm still learning it as well. Then the leverage buyout is here. The free cash flow to equity, this is the model for it. Then the private equity return, this is the model for it. Then weighted average cost of capital, this is the model for it. Now I have a note in this file here that explain what each cell, what each sheet in the model does. The sheet for assumption, what it does. The sheet for income statement, what it does. The sheet for balance sheet, the sheet for cash flow, and then the sheet for property, plant, debt, discounted cash flow, leverage buyout, free cash flow, and the likes. So all this one here, I have a model that does that. And what I did was that in order to understand this model, what I did was I have a ChatGPT subscription. So I uploaded the file into ChatGPT. Then I say, explain what is going on. ChatGPT now begins to break down, telling me what each of the sheets means. And due to my experience in financial modeling, I can be able to understand some things by me looking at it. But anything I don't understand, I will go to ChatGPT. I will ask, why is this like this? Or I will screenshot that part. I will give it to ChatGPT. ChatGPT will now explain it. And because I have basic knowledge already, so when ChatGPT explains, it will be easier for me to connect and then build on it forward. So this is how financial modeling works. This is how you get to create financial model and you get to apply it in what you do. So this is for income statement. You can make more research, know how the cash flow statement is done, the statement of financial position is done as well. And then you can use this to create any model, be it revenue, cost, blah, 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 and so on and so forth. So this is it. And that is the end of what we've been discussing so far. All right. So, questions. If you have a question, you can ask. If you want to add more light, you are free. And if you want to give clarity to something, the door is open.
Okay. Good evening, sir.
Yeah, evening.
I must commend your lecture. It was really impactful. I do have also enrolled on courses on financial model. At least I also saw some things you did there. It was and this was more simplified. Yes. And please, my question goes to building from the actuals. Maybe the company is having historical data. So if I'm building a financial model now, uh, I'm building it based on the actuals. Do you use which percentage do you use? Maybe for instance, I have actuals for the month of July. I have the actual for the month of September. So I'm projecting into the future. So if I'm to use a percentage, which growth rate percent am I to predict into September? You understand?
Okay.
So
Yes.
so my assumptions can be realistic, not like it's just like I'm just putting it there, but it should be realistic and speaking the figures. And secondly, also, when I was going through, when you were explaining for the startup, when you were explaining the financial model for the startup, I noticed that you used assumption of growth percentage for cost of sale. I thought that it is supposed to be based on percentage of revenue. That's why I said, okay, let me ask you whether you have a reason behind it or you just give a percentage to that, or you said is a percentage of revenue. That's what is going to be as cost of sales. So I just want a clarity on that. Thank you.
Okay. Let me answer the second question so that I will not forget. The okay, if you look at this model, the cost of sales is what we have here, which is exactly what we have here. So the cost of sales is actually presented in their values, not in percentage. But it is the growth rate of the unit produced that was actually presented in percentage. Because if you observe carefully, you could see that here the value is this, and then we now use it to calculate this value here by multiplying them together. Now, I presented them here as values, but if I want, I can actually use percentage. You get, if you want, you can actually use percentage, and in that case, you probably create a smaller section in between these two lines, and then you now hard code the rate of change in the manufacturing cost, that's per order, and the rate of change in the order fulfillment cost per order. Now, in the income statement, the typical income statement we all know of, the only thing you see here is your revenue is this amount, your cost of goods sold is this amount, your gross profit is this amount, your gross profit margin is this amount. But that's based on what the company, based on the performance of the company. But in modeling, you can actually present it as a value or you present it as percentage. So I don't know if this actually answered your question, or if there is an angle you want me to approach it. Is it okay? Approach it from uh,
Okay,
Chukwebuka.
okay. Yes, sir. I get where you're coming from. I understand. I understand where you're coming from. Yes, I understand
But
it.
what you are trying to say is different, right?
Yeah, because what I noticed is, because I was building a model last month. So when I was building it, I also asked ChatGPT. He said it's based on percentage of revenue. You understand?
The
So I
cost.
was trying to,
Sorry,
yes,
the
the
cost
cost of sale.
uh, is based
Yes,
on
he said I
what?
should use percentage of revenue. So
Okay,
if I'm doing
okay.
any assumption, sorry, I was
Okay,
building
I
from the
understand.
actual.
Yeah, I understand the point now. I understand the point now. So what you are saying is, if you are presenting your cost of sales, it should be based on percentage of the revenue. So technically, it's the same thing here. It's just the approach that differ. And this is it. If, for instance, I actually have, let's say, 160,000 in this cell, and then I want to calculate my cost of sales. Let's say this is my revenue, and then I want my cost of, what am I typing? Cost of sales. So now, from your point of view, is that the cost of sale, I will now look into this revenue, and then I will now I will now calculate a percentage that will be captured as cost of sales. Maybe I will, based on historical data, I can say from 20 this, 20 that, or from January, or from the previous metrics, probably I come up with, let me say, 23% as my cost of, as the percentage, what am I typing? 23% as my percentage. Then I will say, okay, what is 23% of this? Then the value will appear here. Then that will be my value for cost of sales. That means I have now used the revenue to get the cost of sales and model it this way. So this approach is technically the same with this approach as well, because if you look carefully, in this aspect, we went deeper into the production levels. We started from the production unit, which is more technical, to understand that this is what we have and this is what it resulted to. But however, we can actually do it this way. If we say this divide by this, then we converted this to percentage, for instance, let's say. Now, this gives off 24%. We can actually do it from the other way by saying we got 160% here, which is this. Then our cost of sales from the previous record, based on our analysis, we got 24%. So therefore, we want to see what is 24% of this value here. Then we will now have 38,400, which is, okay, we have 38,000 here. And then is there any, that 8,160, 24%, that 8,400. Anyway, you get the message. There's one, I
Yes,
don't
I
know how this
understand.
400 come to be, but you
And
get the message. So yeah, so
yeah,
you
yes.
come to see that you are still aiming at the same direction. The only difference is that in this aspect, you are more thorough. You went in depth to actually model the production process and bring out values based on what is happening inside production plant from site. So that is just the difference about it, but you are still aiming towards the same direction.
Okay. Thank you.
Then,
Thank you.
the second question was what?
Okay, I talked about, let me go through this thing.
I forgot this, the second question.
Okay, maybe I will remember. I'll call back to you because I know this
Please,
one was.
who is with us? Who remember the second question?
Go back to model.
Well, if only we can play it back, then we will have remember. But anyway, if I watch the playback, I will answer the question. The second question was more technical than the first one. That was why I had to answer the first one before the second. But when I go through it, if I will just, even if it's a voice note, I will send it to the group.
Okay, no problem, sir. Thank you.
All right. Then someone asks in the WhatsApp group, He said, in accordance to the 10,000 template, what should be my step-by-step as an accountant for my end of month reporting to the management? And I want to walk, please, I want you to walk me through what template. Okay, so what he wants is from the list of 10,000 plus Excel templates, he wants to know if he is preparing a report, which template will he use? So the answer to this question is that, first of all, you need to identify what you are preparing a report on. Is this report on business operation? Is it report on revenue? Is it report on sales? Is it report on cost? Is it report on human resource? Is it report on operational expenses? Is it report on inventory? Is it report on assets? You need to identify what you are creating report for. After you've done that, before you can now start interpreting the report and creating and presenting the report, or how will I even put it? When you identify what you are creating the report for, then you can now begin to present, you can now begin to do your calculation. If the report is on sales, or let me say, if the report is on overall finances, you are trying to look at cost versus revenue for the past 1 month. That means you need to take a record. You need to lay hands on the financial record and understand how much the company makes. Then you also look at how much the company spends. Then you now do the deduction in Excel. After you are done with that, before you copy the table and then you use one of these templates. There is this reporting template here. Where can I find this? This reporting template. Empty. Okay. All right, this is it. These are different reporting templates. Although this is not part of the 10,000 Excel document, but these are different reporting templates you can lay hands on and just pick something to work with. If your report is on finances, you click on this. If it's on marketing, you click on this. So if you open it in Microsoft Word, this is how it looks like. Your organization might not work with this template. They might say, this is too busy, I just need something simple, blah, blah, blah. Then you just make something simple for them. Then I will show you a sample of a much simpler report. But here now, you don't need overview of the company because you are send this report to your supervisor per se. You just need maybe a short executive summary. Then you can copy your table or create a chart in Excel. You paste it here because the table will be linked to Excel. The table will be linked to Excel. Then this is the income statement. You interpret, create a chart for it. Just go through the report. It's quite explanatory, and you get to see. Then there's a more simpler way to actually present a report that will not have so much busy information. Let me go back here and open this SPSS course. This SPSS. Is it module 7? Okay, let me check module 8. Customer satisfaction survey. No, not this. Then it should be, I don't know, just a few minutes. Okay, this is the report. So this is a simple report on the impact of ad spend, clicks, impression, and conversion on sales. Meaning, this is a report on adverts, the clicks that we're getting from the advert, the impression, the conversion. What impact does it have on sale? So your topic might be different, but you just write the date, and that's all. Just report on the topic, the date, that's all. Very simple. Then you introduce, you present your table, you interpret what the table says, You present your table, you interpret, present your table, interpret, present table, interpret, and then at the end of the day, you give your findings, you make your conclusion, and then you make your recommendation. The report template I opened earlier, the financial report template, also have something similar to this. So there is a section where you can do all of those interpretation. So you can use that as a format to actually make your report and send it. So if you create report and send, if your supervisor or your boss accepted, then that will be your format. You get, but that template is just to guide you. So if you might use that template, you go, oh, what's this? What's this? It's too busy. Come on, give me something simple. Then you have to remove some of those distractions, or you can actually create a simple